Everybody here today. I'm Valerie Glynn. I'm the president of the Cranberry Country Chamber of Commerce, and today we are joined by Michael Carr and Keith Perry from Citrin Cooperman, and they're going to help us with a roundtable discussion to review best practices with attracting, retaining, and developing key employees in a very competitive marketplace. So we're going to be looking at current workforce challenges, best practices for workforce recruiting, and also how to design effective employee incentive plans. We all know that it's very difficult to find good employees, and then when you find them, you really want to keep them. So Michael Carr and Keith Perry, I'll let you take over. Thank you for joining us today.
Yeah, thanks, Valerie. So as Valerie said, I'm Michael Carr. I'm a partner at Citrin Cooperman up in the Braintree office. We also have a Woburn office. I'm joined with Keith, who's one of our great supervisors here in the office. We're going to talk a little bit about some of the statistics that we've seen, from some of our surveys with people and how difficult the challenges of recruiting and marketing and getting those employees right now, and some of the important factors to consider. And then when Keith's done with that, I'll kind of jump into what we call kind of a 21st century incentive plan. So we've built some of these incentive plans for clients, and the goal is to obviously retain employees and create a better environment for employees. So I'll let Keith get started here with some of the statistics.
How's it going, everybody? I'm Keith. I've been with Citrin for about 5 years now. I work in our audit and consulting practice, and I specialize in construction, manufacturing, and distribution. Also, I'd like to apologize. I'm actually having some video difficulties. So we figured it made sense to put together this talent crunch, as many companies are looking to fill open positions, retain employees during these ever-changing times. One way to do this is by thinking outside the box. This will help your company grow, attract professionals, and be a leader in the marketplace. There are a number of companies out there wondering why their turnover is so high, or why they are not scaling their business as fast as they'd like. Let's take a deeper dive into why. 87% of companies are facing some sort of difficulty when recruiting. 72% are predicting it will get harder to attract professionals in the future. 51% of firms have increased their pay, and 25% are looking to improve benefits. And a result of that, believe it or not, is they are still losing talent. So the top 3 polled questions in this independent study were as follows. How would you describe your current workplace challenges? 41% believe both professional and craft are going to have a hard time filling these positions. 21% believe craft are going to have a hard time, but not professional. Approximately 15% are having no trouble filling any of these positions, and 10% are not looking to hire at all. Do you expect any changes in the availability of professionals over the next coming 12 months? 48% believe it's going to be harder to find these qualified individuals. 28% believe it's going to be just as hard as it is currently. 14% are unsure, and 3% believe it'll be easier to hire these professionals in the future. Is your firm having to increase pay and/or benefits to retain and/or recruit workers? 51% of blue collar are not increasing pay. 49% of professional are choosing to increase their pay. Approximately 20% of both craft and professional are looking to improve benefits. And blue collar workers, about 15% of them are looking to pay more overtime as a way to entice these potential workers. So you might ask yourself, why is this so difficult? It's due to an aging population. Boomers are aging out and looking to retire. It's due to the public perception. A lot of people are reading reviews or looking your company up online. Attraction to other industries, either through different business structure, increased pay or benefits, or a better work-life balance. More often than not, it's due to an outdated approach, meaning the company's methodology and/or corporate structure is old and needs to be revamped. One of my favorite quotes by Albert Einstein: insanity, doing the same thing over and over again and expecting different results. So one of the ways to refresh your company is to look at your employment brand. This simply means your reputation as an employer, which breaks into three major areas: your goals, your strategy, and how others or your employees view your company. Why do you want to evaluate your brand? Professionals under 40 are 61% more likely to associate employer brand with job consideration. I personally believe millennials are turning more towards social media and reviews to select their potential employers than those before them. A good way to brand is through LinkedIn. So what is your brand? Your brand is your unique culture, your employees, how you treat and value them, their goals and their thoughts. Do you give them an opportunity or a path to grow within the company? Why does your company exist? What is their mission? And what are your plans for the future? Companies turn to benchmarking as a way to evaluate this. They look at others in the industry, evaluate how they are doing in comparison, set goals for your company, and work towards those goals with both your company and your employee. So how do we improve your brand? We treat candidates like clients, respect their time, and more importantly, add value. Leverage the technology and community you have at your disposal to reach out to the community. Focus on networking. Meet people, stay in contact with them, and grow your relationships. 3 local ways to do this is our favorite Cranberry Chamber of Commerce, the Metro South Chamber, and the Taunton Area Chamber. Approximately once a year, these 3 chambers join together to do one joint event. Most importantly, promote success, both of your company, your employees, and your business partners. What is effective recruiting? Put a team in place and focus on marketing and branding. Be aggressive in your industry. Use technology and social media to your advantage. And use employee testimonials as a way to grow and talk about your business. Here are some common recruiting process mistakes: lack of appropriate personnel, a bad candidate experience, either with previous or current employees, poor job descriptions. Remember to take the time and write a thorough job description for the position you were trying to fill. A slow process. Now more than ever, people are looking for jobs. Respect their time and move diligently. Lastly, poor selling or a bad offer. Remember, it's a competitive marketplace and qualified individuals are in a shortage. So how can we improve this process? Put a formal team in place with a team leader. Train that team on interview techniques. Give them structure or a way to rank candidates. Establish a role and metrics for that role. If an employee is doing well, remember to reward them. Treat each candidate like a potential client. Value them, listen to them, and more importantly, grow with them. Remember to move quickly and respect everyone's time. It all comes down to a change of attitude. Putting the right person in the right position has become one of the most important factors of corporate success, and it will help your company grow, retain, and attract employees, help employees reach their career goals, and help you be a leader in your industry for years to come.
Thanks, Keith. So as we all know, I mean, the stats kind of speak for themselves, and I think especially right now, you know, with the unemployment rate where it is, and nobody really knows how this COVID thing is going to play out, right? So I think one of the things that we've been seeing a lot with our clients is incentive plans. So I've done a lot of work on this with clients, especially over the last, I don't know, 3 to 5 years. It seems to be becoming more and more prevalent. I specifically work with a lot of construction clients who, seem to have had the same attitude for a long time. And when I look at incentive plans, I think about the key word there, right, is incentive. And a lot of the ones that I come into as far as bonus plans or whatever you want to call them, typically, the company gets to the end of the year, they take a look at profitability, they come up with some number, and they start allocating some funds across. And statistics show that after maybe 2 bonus payments or whatever you want to call it, they become expected, which to me is more of like extended salary. It's not really incentive, right? So incentive should be a way to incentivize your employees to help grow the company, to help grow the bottom line. So what we're going to be talking about for the second half of this is really what we call ownership thinking. There's a book out there, you can find it on Amazon, etc. It's actually called Ownership Thinking. It's by Brad Hams. I was out at a CFMA conference in Chicago, I don't know, about 6 years ago, and I was able to meet one of the people on his team, and we had some great conversations about this, and we kind of came back and tailored it, like I said, to my construction base. So when we get to some of the examples, you'll see it's kind of based around construction because that's kind of my go-to. But so what ownership thinking really is, it's about kind of ending entitlement, creating a culture of winning, and then the plan piece of it, the actual incentive plan piece of it, it really revolves around this whole thing called self-funding, meaning it's not really an expense to the company because the goal is to teach the employees how to create the value, how to create the profit, and then essentially fund their own bonus plan. So, it's one of those plans where the sky's kind of the limit once you set the bar, and we'll kind of get into that. But it's a really good way to motivate and incentivize employees while also teaching them some things. And we'll get into what kind of goes into this. So, like I said, it's a company-wide thought process. The goal is to appeal to both millennials and boomers. I feel like in the booming age, it was more, I come to work every day, 9 to 5, I get the bonus at the end of the year, I'm happy. Millennials seem to be much deeper as far as the knowledge that they want to know what's going on in the company. They want to know how it's performing. They want to know how well they're doing. So that's another piece of this, along with, part of this, and we'll talk about it, is training. I've done a lot of training. One of my clients had about 400 plumbers that I trained on business finance, and we try to relate it to personal finance so they can kind of, keep up with us and not get weirded out by some of the KPIs and the different terminology that's used. We try to, relate the two so they really understand it, and hopefully it'll help them with their personal finances as well, perhaps. um, Creating higher profit through engaging the employees, and obviously it benefits both the owner and the employees, and we can kind of talk about how that's explained to the employees and how it works and how it functions. So what do owners think about? Obviously, profit, cash flow, risk, the competitors, their employees, of course, keeping them happy, controlling costs, et cetera, right? So we have this higher level um, of thinking on an owner, right? Versus an employee, maybe, they're thinking about paychecks and benefits, healthcare, getting their job done, security, time off, all those different things, right? So there's a little bit of a disconnect there. So the goal is to take this employee list and sprinkle in some of the things from the owner list and get everybody on the same page, on the same team, going towards the same goal, which is ultimately profitability, right? Because the company can't continue without profitability. And I can tell you, when I went into one of these companies, they had lost $2 million. They were $2 million on the line. The bank was going to pull it. They were going to go out of business. So it was kind of a last ditch effort to save this company, and ended off, working out quite well. This past year, I think we paid out almost 27% bonuses to every employee for 2019. And then, we'll be wrapping up 2020 shortly this year. But, it can have a very massive effect on culture as well. And we'll talk a little bit about that as we get into it. So what can it do? Hopefully, end that entitlement piece, right? Like I worked for the year, where's my bonus? Not really understanding how or why we got there, or, like that company, they lost $2 million. Obviously, they're not going to pay any bonuses. And who gets pointed the finger at the end of the day is management or owners, right? Like I came to work every day, I did my thing, no different than last year. Why didn't I get my bonus? And that's really just because they don't understand it. So a lot of this might be difficult for some people to accept, which part of it is opening up the books a little bit to the employees so they can understand how the company's actually doing. And through that, hopefully we create some teamwork, get rid of that whole me attitude thing, and then, like I said, hopefully drive profits through these shared goals. So what is entitlement? It's obviously just the fact that they get paid in bonuses and whatnot because of who they are, not exactly for what they do. So the goal with this is to eliminate that and hopefully create a plan that's understandable. So at the end of the year, they see the numbers, they know how it works, they know how to calculate it, they can actually calculate their own bonus. So that way there's not kind of this weird thing where they believe the owner's trucking home all this money and they're not getting anything, right? So what are the great traits of companies, right? They care, have fun, obviously winning, and usually they're most financially successful. um, and I think that's pretty common amongst any great companies is, certainly they care, I think, is the biggest thing. And I think part of this plan is really showing employees that you care by involving them in this process, right? And it's not necessarily that they get equity per se, but if they're sharing in the bottom line and creating their own bonus pool, then technically they are a bit of an owner, if you will, because they're sharing in that profit. Normally it just goes to owner equity, but here, a chunk of it would go to the employees. So what's the process? So ownership thinking really follows this curve here, right? So the first key is you have to have the right people. And a lot of times when I go into the companies, for the most part, they do have the right people. And the goal is that we want to retain those people. So it's just starting with the right people, giving them the right education, figuring out the right measurements, and then getting the right incentives, right? So it's this curved process here, and it starts with the people, and then we kind of come in and help with the education piece, figure out the measures, and figure out the incentive portion of it. So why do the classic ones like we talked about fail? Either they're too complex, sometimes there's all these crazy measures and different metrics that they have to hit and all these different things, and nobody really understands it. On top of that, there's a bit of a trust issue there. Sometimes employees don't believe it. They think the owners are just messing around with the numbers or deducting from their potential bonuses and so on and so forth, which subsequently creates that whole entitlement issue. Like I talked about, typically after 2 payouts, it becomes expected. And then when it's not paid, like we said, employees tend to blame management, which is what we don't want to do, right? We want to be a team. We want them to understand it. If we didn't have a good year, we need them to understand that. And then we need to figure out as a team how to get better and how to create that profit to get back on track and create those incentives. So what have I seen in some of these plans? Separate fiefdoms, they're too discretionary. A lot of times they're not really even attainable. So the employees don't really perceive any value there. Poorly communicated goals, typically, like I said, it's a lot of times it's just we get to the end of the year, here's how we did, I need to put this amount to equity and this is all I have left. And then I'm just going to dish, certain amounts to certain people. And there's no real link to work in that, which is an issue. And then obviously changes happen during the year. We might be doing well. They start communicating that we're going to have this great bonus, and then Q4 falls off or something like that, and then it goes away. And then again, management gets blamed, which is not what we want out of one of these plans. So what's a good plan? I talked about this a bit, but self-funding, right? So that just means the employees create essentially the bottom line that funds this plan. So we'll talk about it a little bit, but we create a shared goal that covers certain things like the company and owner's return on investment and growth, et cetera. But anything after that essentially funds this plan. It has to have a perceived value, right? So they need to feel like they're going to get something out of this. Shared targets, so known targets, shared targets, agreed upon targets, all important. Understandable goals, stretch goals. We'll talk about those, what the planned profit is, what the stretch profit is, and then just aligning the behaviors with business objectives. So it starts with the right people, like we talked about. So if you look at this graph here, right, we got values, so that's essentially culture, right, and then performance. So he groups it into this 4 buckets, which I really like, which is the skunks, the puppies, the stars, and the terrorists, right? So we want to take essentially puppies and turn them into stars. Skunks are always the easy ones, they're just not good for culture. They don't perform. Those are the easy fires, right? I think most people can pull the trigger pretty quickly on one of those types of employees, right? They're not performing, poor values. It's fairly easy. I think the hardest one on here is the terrorists, and I like that he calls it that, because these are the ones who tend to have that ego. They're really good, they do perform, but the problem is they just bring everybody else down. They bring the culture down. They're the ones who are always talking crap about the company, if you will, or and they're the ones who essentially drag the stars and the puppies down into the wrong buckets. So those are the hardest ones. And I can tell you, every time I've gone into some of these trainings, I can always tell who the terrorist is, because they're the ones who just constantly push back on every little thing that we're trying to do. But when I talk to the owners, they'll be like, oh, but he's one of my best, say, project managers or whatever he might be. And then I'll be like, well, we'll see what happens. And then shortly, within a year or so, they're gone, and some other puppy comes in and steps in and becomes a star and takes over for that person. And then the owner eventually comes back and says, I never really knew how bad that person was to my culture, and how it say in my industry what he was doing to the apprentices and killing the culture. So I think that's part of the evaluation process within house, right? They always say it's easy to hire, but it's hard to fire. So I think that's one of the harder pieces of this, is figuring out where the employees fit into these, and how do we keep the top two, the puppies and the stars, happy, and start building them as your best team. So what's the right education? What your employees don't know can hurt you. And I think this is key. When I went into that company that was going under, they had no idea. All the employees thought they were like the best thing since sliced bread, and they were doing so well and all these things. So when I presented to them that they had lost $2 million, like, the look on their faces and such was astounding. The fact that they didn't even realize what was happening. Now, we had surveyed them prior, and we kind of asked specific questions, and I'll get that into that a little bit. But their perception of reality was so far skewed that they had no idea what was really going on. And what we kind of found was they might have, they were thinking this owner was trucking home all this money, so they weren't really being as efficient and as effective as they could. They were doing some prevailing wage work, which, as everybody knows, you get paid a little bit more for prevailing wage. And the company wasn't doing that right either. They weren't, withholding the benefit side of it to the 401k. So these guys were actually getting the full prevailing wage versus their normal wage. So none of them wanted to leave those jobs. So they would just hang out and install maybe 1 unit instead of the normal like 7, because they were just stringing this thing out, and they didn't realize that they were actually bleeding the company dry. So I think education is important, and sharing this information is important, especially nowadays. Like we said, with millennials, the more they know, the better they can do with it. So we asked like I said, this was one of the questions we asked, but we asked the field employees. So in a construction client, these are all the guys out actually doing the work in the field. What total percent the company paid in taxes? We were just curious at what people thought. And, they thought maybe 48%, I guess, which is a little high. It's not too far off. But again, I don't know. I had one more slide. I guess I guess it's gone, but we asked them what the net income was, like straight bottom line net income. What do you think it is? And this was a $60 million company. And they said 20%. So they thought, this guy was making $12 million and he actually lost two. So there was like a $14 million disconnect there between the employees and actuality. And then when they didn't get their bonuses that year, everyone was freaking out and all these things. And it really, they just had no idea that they're not as good as they thought they were, and they lost all this money. So like I said, we had to figure that out. And like I said, this past year, they actually made close to $8 million, and we paid out a couple million of that. So what do we do as this process? So after we educate the employees on all these things, we come up with this planned revenue goal. Obviously, what do we want to hit for the top line? What we call planned profit. So what planned profit is it's kind of that bar, right? So we sit down with the employees, we explain to them the goals, what their goals are. Do we want to grow the company? Do we need more equipment? What should the owner get out of this for his or her risk of all this money and equity that they have in the company, or return on equity? What should all of that be? What do we need that to be? Talk about banking, talk about covenants, maybe bonding if you're a contractor, and what do we need to make all this work? And essentially that becomes what we call planned profit, and that's kind of that bar, right? As long as we hit that bar, everybody's happy. Well, the company's happy and the owner's happy. So everything after that is where one of these plans would come into play, where there's a shared piece to getting above that bar. So now the employees understand this is exactly what we need to keep this ship rolling and afloat. So now I get to share in everything that we can create above that. And then the stretch part, that just becomes a goal, right? So you talk to the employees, what do you guys wish your bonus would be? 10%, 50, what is that? And that we can back into that and say, okay, based on the planned profit and what you guys want for a bonus, this is your stretch goal. And then we just try to meet that stretch goal to help them achieve their desired result or the desired bonus. So like I said, we put employees essentially through a financial boot camp. I've had maybe one or two do it themselves, but for the most part, I come in and do it. And it's like with that one with 300, we actually split it up into a couple different groups and sessions because we wanted to keep it fairly personal, but basically just teaching them about companies' finances, right? Teaching them those things that they might not know, profit percentages and cash flows and AR days and all the things that drive cash flow and profitability, and really comparing that to personal finance so they can kind of make the connection between the two. And then hopefully at the end of it, we can connect, their performance with their pocket, by these bonus plans. So we come in, we kind of put them through this boot camp. We teach them some things, like I said, like, hey, your paycheck is our revenue, your bills are our expenses, your savings account is our profit and loss, and essentially that goes into our equity, right? And that's our savings for this company. So really start explaining and teaching this to employees. And hopefully too, like I've had some come to me afterwards after I've gone through different things like what is working capital and all these different KPIs, that they went into the stock market and they started pulling company financials and looking at them before they started investing. So it really helped them on a personal level as well. We talk a bit about cash flow statements, what it means with collections coming in, collections going out. How can we increase those inputs and get their inputs too on where are these leaks? Like, where is this cash going out that we can stop and hopefully get better? And a lot of times these, especially out in the field and construction, those guys, they don't have a lot of interaction per se with back in the office, say estimating or maybe accounting. So a lot of times they have, the knowledge there of where we can find the money, but they just don't have the forum in which to bring it back to us. So part of that too, and we'll get into it, is what we call RIP programs. But we talk a lot about too, it's hard enough to go out and get revenue, right? And the owner's going to go out and typical GC makes 5%. So that's what kind of this example is. But you go out and you sell $1, you're essentially making a nickel, right? And that's a lot harder to do because that nickel is also not guaranteed, right? If your estimating's wrong or maybe things happen or warranty or whatever can eat into that. But at the end of the day, if we can get the employees involved through these RIP programs, finding a dollar adds a dollar. So the quickest way for them to fill their bucket per se for one of these bonus plans is to help us figure out, where are the leaks, where is the cracks in the table, where are we losing, money. And it was funny, we had this meeting at this HVAC company, and this guy kind of just timidly raised his hand. You could tell he was kind of deciding whether or not he should say anything, but we ended off getting him to talk about it, and he had said that he built a wagon. So we're all kind of like, what is this guy talking about? He had literally gone out and bought like this red flyer type wagon. And then he went to Home Depot and he built this whole system on top of it, kind of like a Fastenal system, or if you're at Home Depot or Lowe's, and they have all the little fittings and all the little drawers. So he took all of his fittings. He was one of the guys who would go around, and do all the piping with all the fittings. And he said, when I got here, everybody had all these fitting boxes all over the floor. He's like, I spent hours and hours trying to find all these fittings. So I built this wagon and I lock it up at the end of the night, and I bring it from job to job, and it just makes me really efficient. The owner had no clue that, kind of this is how they were working in the field. And he ended off building like 10 or 15 of these wagons. And it actually totaled out to almost $150,000 in less material costs or less fitting costs the next year, which is pretty wild. But it's little things like that that maybe never would have been brought up. But again, 150 to the bottom, get shared amongst the employees, so on and so forth. So it's showing them how cash flow works, right? The number of days, how we can increase cash just by pushing clients or pushing for receivables. Really trying to get the money through the door, because we can use that for to pay down debt, which at the end of the day equals potentially less interest, which less interest obviously means more profit. So again, just finding different ways to find the money, like I said. So it's really focusing in on inefficiencies and missed opportunities and really getting people involved in that. I like to come in and we start filling up the blackboard or the whiteboard or whatever with all these different things that are issues that the client that the field guys or all the employees are dealing with. And then we take that whole board and we kind of narrow it down to say like a half a dozen or maybe less things that we should really focus on, the low hanging fruit to start, to really get the momentum going and see how we can save that money. So again, we just try to relate that maybe to personal, right? Like, so here's your initial budget. If we just look at things a different way and maybe refinance something or change something or change a budget or whatever, it can really change the impact to the income statement, right? Just by modifying certain things. Or maybe, we have two huge jobs that we just signed up on the construction side, and they're similar, different space. But what if we go to the vendor and we do a bulk order and we can get a discount or something like that? Or maybe if we can fix the cash flow, can we start to take advantage of 2%, 210 net 30 or something like that to get 2% off? And when you start to get into the millions of dollars, 2% can, equal a lot of money. So it's just relating that to them personally so they kind of understand what we're trying to do and where we're trying to get. So that leads into obviously KPIs or performance indicators. And that really depends industry to industry, kind of what those indicators are. But it's a way for us to really measure how we're doing. And that's the goal of the KPIs, to measure how we're doing internally versus ourselves in prior years and so forth, but also externally versus other companies in the industry, or what I call best in class. Whenever I start these, I always kind of show them where they are in relation to best in class so that they can see like that difference in, say, margin or bottom line, and we can equate that to dollars for them. Like, hey, if we just go from here to here, it equals this amount, which equals this amount of bonus. And you have that potential because this other company is doing it, so why can't we do it, kind of thing. So what is the effect of that? Well, hopefully we build this nice strategy, the shared strategy of mission, values, and vision together with the employees. We have these scoreboard KPIs so we can track it. We can do it, and there's a lot of different ways to do it, but in construction, typically there's field, then there's management, and then there's office kind of thing. So you can have departmental goals, like in the office, maybe getting more paperless, trying to find those discounts. Out in the field, finding ways to reduce waste, get more efficient on projects, etc. And then that kind of flows into what we call those rapid improvement plans, or RIP programs. And those are the ones that we pull off the board, and we really create this scoreboard, like, hey, here was the RIP program that we designed, here's the goal of it, and then here's a potential benefit of it to the bonus plan, but also here's a celebration, like if we do this, we're going to celebrate it together. And I'll go through an example of that I did with a concrete contractor. But some of the things like I look at, like as far as performance indicators, again, this is a little bit construction based because that's kind of my space, but just looking at like labor costs, right? Hours to estimates and cost per hour per employee and so on and so forth, waste on materials purchasing, rework, warranty, all those different kinds of things, right? Those are all things that we can measure, and then we can compare the results and then share in those wins together at the end of the day is the goal of these. Same thing on the other side of revenue, right? Like how many proposals are going out, how many bids, what's the percentage, what's our bid hit ratio, right? If our bid hit ratio is too high, our pricing's probably too low, and vice versa. So it's really looking at all those things to maximize, like I said, at the end of the day, the profit of the company. So what is the rapid improvement plan? Well, basically we select one of those things, right? It could be anything within the company, but something, say, reduce material waste or something like that, or in that example of the guy with the wagon there, reduce fitting waste. So you determine the objective, the duration, when you want to achieve that goal by, quantify the financial benefits, they understand like exactly what this is going to do for them, create a theme, and then identify, like I said, a celebration. So here's one, like I said, I did with a concrete company. So what we found with them was they were spending a ton of money building forms, right? And so we were trying to figure out, okay, how can we reduce that spend, because it was a big spend. So it was on the board. We figured it was something that we could do. So you can see here, we created the objective. We made it 90 days. Again, this is an old example because this was one of the first ones I did back in 16. But what they came up with was, we're going to clean all the plywood, at the time of stripping, so it stays good. We're going to oil it beforehand, so when we pull them off, they don't break. When we make them, we're going to use scrap, and so on and so forth. Hopefully reduce it by 100,000, which will increase our profit by 100,000. In this case, 33% of that overage was going to the employees, 33% was going to the company, and 33%, I believe, was going to taxes. And then at the end of the day, that's going to increase the company profit by 52%. And then what we did for them, if they hit it, was we actually sent them out for essentially a field trip. we had sent them all to Foxwoods, and I think it cost us like $15,000 or something. But it really got the ball rolling, and it really showed them that we were behind them and that we were serious about this thing. And like I said, after all that, the company still was able to get 52,000 out of it, while the employees got the 33. Again, some other examples that I've seen at a company, taking discounts 30 grand, customer returns 15, paperless 5, so on and so forth. Again, for a total savings of almost 142,000 for the year. So if you start sharing that with your employees, this is really where I call it self-funding, right? So by finding that 30 grand, now it goes more, a chunk of that goes to the bonus pool. Customer returns go to the bonus pool, so on and so forth. So the employees are actually filling the bucket with all of these things, and essentially paying themselves their own bonus by finding all these cracks in the table, as we talked about. So a third, like I said, a third for taxes, a third for the company, a third for the employees. What some of my clients have done is built that third for the company kind of into plan profit, and just said, look, this is what we need for the company. We're good with this. This achieves our goals. It achieves our working capital. It achieves everything that we want to do as far as hiring more or buying equipment. It covers us. So I have some clients that'll do here's our planned profit. And then after that, it's 60-40. You guys get 60, and then the effective tax rate or whatever it is, that we'll keep that, but we'll give you guys the rest. And essentially that means the sky's the limit for the employees, right? There is no cap. I remember that first one we did with that HVAC company when they started making the money and stuff. And then this past year when he had to cut, and we'll go through it in a minute, but we hold some of it till the end of the year. So we bank some just to keep, that motivation there and to keep people around and retain them. So when he got to the end of the year and he had to cut, it was almost $2 million worth of checks, he was like, his hand was like shaking, cutting them. He's like, should I really? And I'm like, yes, the business got its cut, 5 million, we can certainly cut, 2 million of checks back to the employees. And we had this big celebration and we handed out all the checks, and it was pretty cool to be a part of. So what are some of the other non-financial outcomes? Pride, satisfaction, job security, morale, teamwork, etc. One of the things that I saw in construction was, under the old methodology, our best project managers used to just go after the best projects. They knew who the good customers were. They knew what projects were going to be super profitable, the ones that would make them look good, so on and so forth. What we found after this was there was a shift in mindset with those guys. Like, okay, if I take all the good ones and I leave the difficult, the tough jobs to the lesser experienced project managers, that job is just going to get progressively worse. And if we're sharing in net profit and that gets progressively worse and turns into a lost job, now it's eating away at my bonus. So what we found was, the all-stars were starting to step up and say, okay, I know that's going to be a really hard job. I know it's going to be a really difficult client, but I know I can make it work and I know I can make it profitable. So give me that one and give, the less experienced PM this client and this job, because there's no way that job can go wrong. Right. So it's kind of that shift in mentality, which can make a huge change, right? Because now you get your best employee working the hardest job and making it profitable, instead of having, say, maybe a green employee working it and just it's getting worse and worse and worse and eating away and eating away. So part of this, hopefully, like I said, is to create that difference in mentality, if you will. And then another thing too, as far as succession planning and things, this is a great way to potentially lead into like an ESOP plan or something where the employees are going to take over. Well, now they already know the finances, they're already a part of it, they kind of get everything, so it can lead to a much easier road to an ESOP plan. So some measurements that you might want to consider, obviously the growth targets, adding in maybe some different quality control processes, evaluating individual performance, and particularly maybe on a contract like job performance is one of the things that we looked at. What we kind of layered into some of this on the quarterly level when we do the payouts is there's like an employee checklist, like did they fill out their daily reports? Did they do this? And if they did all that, then they get the full 50%. If they maybe missed out on some of those, it could reduce the 50% to maybe they only get 30% of their bonus for the quarter. And instead of banking 50%, we're banking 70%. And it's still there for them, but it's motivating them to get back on track with everybody, be a part of this team, and do, all the different things that we're asking you to do. So some questions as you're building these to consider: what's going to be a threshold, right? What is that number that the company really needs, for banking, for whatever, like I said, capital. What's your stretch goal going to be? It's talking to the employees. What do they really want to be like? I mean, statistically, we know 10%-ish is motivating for employees, but maybe your employees are different. What is their goal? What is their stretch? Obviously, total payroll dollars, number of employees is important to figure out, and how to back into those numbers. What is their share going to be? Are we going to cap it or not? Typically, I haven't seen a cap, but potentially you could cap it. And then how are you going to distribute this and track it, and so on and so forth. And a few of the clients have hired us to come in quarterly, do the calculations, present the calculations, send out the letters to give that kind of third party trust, if you will, to the employees, so they don't think the owners are messing with the numbers and changing things. So here's a quick little example, just easy numbers. Plan profit 300, so you got to hit 300 first. And then again, I think here it's 1.4 million of payroll. So if we want to get to the stretch goal, of 140,000 or 10%, then we'd have to hit that 650 mark, right, to hit that stretch goal. A distribution example, again, based off that, you get half, each quarter, and then in Q4 for the Christmas time or whatever it might be, you get the remainder in the bank. Typically, it's paid out, sometime in January because we have to do the calculations for Q4. But it typically it's the bigger payout, and that's kind of the incentive that keeps the employees around. And when we typically build these, we kind of do it almost like a 401k. We kind of do a summary plan description like an SPD, goes down all the provisions of the plan for the year, talks about plan profit, so on and so forth, so that it's there, it's memorialized, everybody knows what it is. And then when you get to the next year, you reevaluate it with the employees. Maybe you grew a lot. We need to raise that bar for the next year, which in that company over the 5 years, we actually had to raise it each year because they kept growing and growing and growing. And, they were non-union and they were actually starting to attract union employees, believe it or not, because they heard about this plan and the payouts, and they really started to attract some really good employees. But again, really simple example here. You can do it a lot of different ways, and it's all laid out in that book. He goes through many, many industries in that book, so I definitely think it's worth a read for anybody interested. So that's really it on the incentive plan side. I wanted to leave enough time here for any potential questions that you guys might have for me or Keith. But like I said, I've done, maybe at this point, probably 10 or 12 of these. And they've all seemed to have produced pretty solid results. I can say that some are slower to get going than the others. I kind of equate it to like a snowball on a hill. And, you really got to get the ball rolling, if you will, and get those payments to start, or otherwise it's going to lose traction. And really what that comes down to is management and owner involvement. If I found if the managers and the top level people in management and the owners really get involved and really push for it, then it's a hill, and that snowball just starts flying down. When owners don't get involved, it might not be, as steep of a hill. It might be a lot slower to really get it there. And so it really takes buy-in, I would say, from management is the biggest key. And then maybe the first year as ownership, just saying, you know what, we're going to set the plan profit just a touch lower than we really think, just to leave some meat on the bone and really start to get those payments going each quarter to really show the employees that we mean business. I started one of these with a client in Q4, so everything was getting paid out, and they had a pretty good year. So he just said, look, plan profit 0 for Q4. So whatever you guys produce for Q4, we'll pay it out in bonuses. And they did pretty well, and we paid it out. And then coming into the following year, they really hit the ground running on Q1, and they were really fired up about it, and really came forth with a ton of ways to save money and holding each other accountable, and so on and so forth. So feel free to pepper away any questions. Happy to answer anything. And I was telling Pam and Valerie beforehand, we actually have an article about this as well, so we'll probably distribute that out to the chamber afterwards as well. But feel free, if anybody has any questions, feel free to ask away.
Well, Michael, it's Valerie. I just want to say that I didn't realize that you had such a scope of products and services. This is great to know. And certainly for companies who, there's a direct correlation between happy employees and the amount of net profit you make. And this puts it in a nice path to go in that direction. So any company that's looking to improve would certainly do well to engage with you.
Yeah, and I think there's a little bit of a misconception out there too about Citrin itself, because we are, fairly large. We're just over 300 million and about 2,000 employees. However, we kind of call ourselves a super regional firm. And what I mean by that is each region, so say, the Boston region, we are our own entity, our own office, and that's kind of how we run. So we have our own managing partner, and everything stays in-house. So it's really a small firm, but we have like the bench to go and do anything a client could ever possibly need. So I actually help lead what we call the business advisory services group. And typically my highest revenue client might even, is typically 60, 70 million tops. I work with a lot of 1 million, 2 million, $3 million companies, and I do a lot of CFO training, controller training, QuickBooks. We help consulting with QuickBooks. We do software implementations and tax planning, and we really get involved with smaller clients. So anybody in the chamber, don't feel intimidated. That we might be a bigger firm. You're still going to get that small firm feel. Every one of our clients has full partner involvement. So it's like I said, it's kind of like going almost like to a sole proprietor. When you come to me, you're going to be working with me directly, and then I do have resources up and down, any type of issue you might have. So I'm happy that we got to be in front of you guys, and hopefully there's some members out there that might need some help, and we're happy to help.
Michael, are you a part of the workforce training express program at all? Provider?
I am not.
Yeah.
Andrew, Inka, Pauline, Maya, any questions?
Not everybody all at once now.
No questions, thank you.
Well, we appreciate, we appreciate the
No
opportunity to be
questions.
here, and we're so glad that you guys joined us. And our contact information, I can bring it back up here for you guys. You can certainly take that down, and feel free to shoot us an email or anything if you guys have any questions or anything like that, and happy to help anybody. We don't charge for small stuff like that. Like I help a lot of non-clients a lot of times with questions, so happy to be a resource for anybody in the chamber.
So, and that's how Keith really looks, huh?
Yeah, that's his picture.
Oh, yep, there I am. The best part is I'm probably going to get on another call and the camera's going to work, no problem.
Right.